When it comes to gambling, a popular saying is that the house has the edge, which means the odds are mathematically in the casino's favor. Investing in stocks is pretty similar, except BlackRock has the edge. Luckily for us though, there are plenty of investing techniques out there that are basically guaranteed to make you a profit over the long term. You won't learn it from school. You also won't learn it from the bot comments under every finance video advertising an AI-generated ebook with an AI-generated cover and summary on the back. In reality, investing is actually one of the few skills in life that is best learned from people who are really, really bad at it. As in, they transferred their entire life savings into a Robinhood account, funneled half that money into one penny stock, and of course, to manage risk, they put the other half into an explosive tech company that's gone up 50% in the last month. A common theme with bad investors is that they invest in stocks not just with their money, but with their emotions. On top of that, they tell you every quarter that the company will start making profit next quarter, and that they themselves have come up with an advanced stock forecasting model that predicts the price is going to shoot up in a matter of days. And maybe they're right, maybe they're wrong, but the reason why you should learn from these people is because they'll teach you that either one of two things happen. Either you lose 80% of your money and then you lose the other 20% trying to make back what you just lost, or you get lucky and double your money, and then you lose everything by trying to double it again with a different stock. Indeed, the main difference between a 1000% return investor versus a negative 100% return investor is neither skill nor strategy. It's what four-letter acronym they decided to gamble on. It might be tempting to think this guy is a genius investor, but let's say I go to a roulette table and I put $10,000 on green, which by the way only has a 2.63% chance of winning. And then let's say the ball actually lands on green, which means I 35x my money and I get a $350,000 payout. That doesn't make me a good gambler. I just picked the one color it happened to land on one time. Doesn't mean I should teach you how to play roulette. Now before we get into investing, you may be extremely worried about the AI bubble. Perhaps you have nightmares about a 2027 recession solely caused by one of the urinals at the NVIDIA headquarters not getting flushed. In that case, the investing method that'll keep you safe in almost every scenario is a method devised by John C. Bogle, the founder and former CEO of Vanguard, who beat the odds as the first person to simultaneously own an investment company while also being generally considered as a good guy. He's estimated to have saved investors about $1 trillion in fees, while letting Vanguard's profits go to its shareholders rather than himself. This resulted in his net worth in 2019 being only $80 million, which is less than Barbara from Shark Tank. And for that reason, I'm out here reading his book, The Little Common Sense Book of Investing, using today's sponsor, Shortform. Shortform is available on your phone or on your desktop as a pretty much never-ending library of nonfiction books, which you can access full guides to at any time. If you don't find yourself having the time to read, or you want information on a topic quickly, this will help you like it helped me. For example, just looking up Bogle in the search bar gave me 4 different books talking about his investment style. Shortform has many other books on investing, but these ones are where I recommend you start, because they introduce the passive 3-fund portfolio that beats pretty much everything else. 1 US total market index fund, 1 international total market index fund, and 1 bond index fund. If you've always wanted to become smarter, and if you've always wanted to read more, this is an actually realistic way you can do it and stick to it. So sign up immediately for a free trial using the link shortform.com/easyactually, which will also give you a $50 discount off your subscription. The link is down below. That's shortform.com/easyactually. Now with that in mind, what is the best way to invest? Well, the best investment, of course, is the one that brings you the most happiness. In the financial world, this equates to whatever investment makes you the most money. So when people tell you that index funds like these ones are the best investment, they're kind of wrong, because you could have always just bought Dogecoin in 2020 and sold it in 2021 for a 35,000% return. But the chance that you actually do pick the best investment, or even a good investment, is pretty low. What you want instead is an optimal investment. And that's what people mean when they say index funds, like the ones I just mentioned, are the best, because they are very close to the optimal investment based on available research, historical data, and mathematical models. They're a predictable way to get a high expected return for a quite low amount of risk. But there is still risk. Usually, no one ever explains this, and they make index funds seem like the safe option made for librarians who drink chamomile tea and play board games on Friday nights. No, index funds are risky, but the high expected return makes it one of the few times in investing where taking more risk is mathematically worth it. Risk is the possibility that the actual return of an investment will be different from its expected return. Expected return is exactly what it sounds like. If the expected return of an investment is 5% per year, you're of course not guaranteed to get 5% a year. But if you simulate 14,605 different universes and you made the same investment in each universe, the average return would be 5%. If the risk is 0, that means every single simulation would give you a 5% return exactly. But as you increase the risk, now the possible spread of outcomes is wider. If you keep increasing the risk, eventually you get to a point where you're risking 100% loss for the chance to double your money. A real-world example of this is any stock with therapeutics in its name. The core thing you should know about investing is that sometimes taking on more risk increases your expected return. Let's start with cash. Cash in your wallet or cash in the bank is very reliable. However, the trade-off is that your money just sits there with a 0% yearly return, while inflation is making your money 2 to 3% less valuable every year. Inflation will be here forever. You should expect inflation to never go away. In 2077, assuming Chipotle still exists, a Chipotle burrito will be about $50 or more, and it's not even a question, it's a guarantee. Come back to this video in 2077 and you can verify that. So if you're not earning at least a 2 to 3% return every year, the purchasing power of your money is going down. You can increase your expected return a little more with bonds and treasuries. When you buy a bond, you're lending money to usually a government or a company for a long, fixed period of time. Government bonds are not that risky, but they might be a little less liquid than money in a savings account. So for that, you're compensated with a higher return around 4%. Corporate bonds are a little riskier, but that increased risk is compensated with an increased expected return of 5 or even 6-7%. But the investment that's generally considered to be the best risk to reward ratio is the stock market. Historically, the total United States stock market has returned about 10% a year. And even if you think US companies are overvalued right now, current projections still calculate the expected return to be about 8 to 9% per year in the long term. One of the easiest and most optimal ways to capture these returns is to buy a total market index fund that holds a giant basket of stocks. For example, VTI is an index fund made by Vanguard that holds 3,500 US stocks, which is basically every single US stock that you can buy. It's important to know that they're weighted by market cap. Market cap is the share price of a company times the number of available shares, and this can be thought of as the amount you would have to pay in theory if you wanted to buy and own the company 100% for yourself. Inside this index fund and most index funds, the majority of your money will be invested into companies with really high market caps. For example, according to Vanguard's website, if you put $10,000 into the VTI index fund, $713 would go into Nvidia, $612 into Apple, $587 into Microsoft, and $350 into Amazon. But then smaller companies like T-Mobile and Starbucks only get $14 each. Now, this might seem too concentrated in a few big companies. This may lead you to look around for other ETFs to invest in. ETFs are baskets of stocks that you can invest in with just one ticker symbol. Many have themes or specific objectives like small cap index funds, mid cap index funds, value ETFs, factor, growth, equal weight, sector specific, gold, Bitcoin, double leveraged, triple leveraged, quadruple leveraged, bonds, income, and some actively managed ETFs that promise to beat the market or lower risk. While some of these can be wise investments to be more diversified, some are a bit more questionable. At the end of the day though, all that matters is the total return you get. And if your questionable ETF outperforms a total market cap weighted low cost index fund, then good for you. Just know though, that's much easier to panic sell an investment that you know is questionable and risky versus an investment that's already been proven to work over time. It might feel pretty easy to beat an index fund by YOLOing all your money into individual big tech stocks, or even stocks where the graph just looks right. The problem comes from trying to replicate that every single year for a long time. You may beat the index one year, but if you want to beat it 40 years in a row, it's virtually impossible. Or it is possible, you're just not going to do it. If you have money you want to invest in stocks, put it in a portfolio that'll cover the entire stock market, even international stocks, and to protect yourself in bad times, also some bonds. It'll feel risky, especially since your portfolio value will swing up and down, but over the long term, that risk is compensated by an expected annual return that is much higher than anything you can get anywhere else. Lastly, if you're going to hold an ETF for a long time, make sure to choose something with low fees, also called expense ratios. because those fees compound over time. The stock market is very easy to predict. Some people will beat the market index's returns for 1 or 2 years in a row. Some people will lose everything trying to beat it, and then they'll borrow money to try and make back what they lost, and then lose that too. Other people will forget for years that they even have an investment account, but still outperform 99% of the day traders who think investing can replace a job. You don't want to be a day trader, you want to be the person who makes day traders mad. Anyway, if that helped, I'm collecting donations in the form of subscribes to fund the next video.